welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We're also streaming to you live on yorbamedia.com. And I am joined, and by the way, we're also broadcasting to you from the Dallas KFXR 1190 AM Clear Channel studios. But I'm joined on today's show with Vince Molinari, founder of Gate Global Impact, our correspondent for crowdfunding and impact investing, and he brought with him a guest, Daniel Gorfine, Director of Financial Markets Policies and Legal Counsel for none other than the Milken Institute. All right, Vince, welcome to the show. Thanks so much for bringing your guest. And Daniel, welcome to the show.
Hey, Michael, thanks so much.
All righty. Daniel, I'm so happy that Vince got to make the introduction to us. Let me back up a little bit because Vince is so much more eloquent at this than I am. Please introduce Dallas to Daniel if you can, Vince.
Well, great. So I think Dan has become a great friend around this innovation that's coming in markets, and he is such a great thinker, and he's got an extraordinary background with a law degree, and he really spearheads the financial markets policy group and leadership at the Milken Institute. And part of that, and I think is so important to me and why we connected so much, it's the power of the capital markets and how financial innovation can help cure and make social and economic change. So I'm very honored and fortunate that Dan was able to join us today. And Dan, what I'd love as part of this show is really to help create awareness and education to the listening base. Maybe you could just tell a minute about the Milken Institute and your initiatives, and we can jump into some of the crowdfunding and impact investing components, if that's okay with you.
Love to hear it, Daniel. Please bring it out.
Great. No, thanks so much. Great to join both of you today. Vince, as you said, the Milken Institute is a nonprofit, nonpartisan economic policy think tank. And one of the core pillars that we're built upon is the idea that access to capital is truly critical lifeblood for an economy. I mean, it's what facilitates innovation, economic growth. It facilitates job creation. That's why at the Milken Institute Center for Financial Markets, where a lot of my policy work is predicated out of, we're really built upon a belief statement that derives from a simple formula developed by our chairman many years ago that looks at the multiplier effect of finance on human productivity and prosperity. In a well-functioning market, capital should flow along a pipeline that feeds companies at their various stages of development. And it's with access to capital that they're able to implement many of their ideas, they're able to grow, and they're able to hire. And those are all critical things to any well-functioning economy.
Now, Vince, I know that you've got a litany of questions. Let me step back and allow you to bring some of these questions and answers out with Daniel.
Well, and thank you, Michael. And please, as always, jump in at any point because I know there's so much that we both like to touch on with great guests like Dan. Yeah, when we talk about the capital markets, and clearly that's near and dear to my heart, and we've had many spirited conversations around these, what do you think is one of the biggest gaps that exist for capital access? And how do we have financial innovation to help close that gap?
Yeah, that's a great question. So to go back to my depiction of a capital pipeline, you want this pipeline to be fluid, and you want companies to be able, whether they're a startup out of a garage to a company that's mature enough and ready to go public, you want that pipeline to be seamless. At times, you will see gaps open up or problems arise within that pipeline, and I think that during the financial crisis, there were certain gaps that were exacerbated, especially for startup companies and small businesses. So to step back and just look at the overall capital landscape, I would say that during the financial crisis, we saw that with early-stage equity investment, there were significant drops in the levels of angel and venture capital investment. Now, the good news is, since the crisis, the overall numbers have recovered to close to pre-crisis levels, and that actually does surprise a lot of people to hear that overall angel investment, overall venture capital investment is close to pre-crisis levels. But that doesn't tell the whole story, because when you look at where that early stage investment is going, it's increasingly going to later stage companies that are effectively less risky than true early-stage startup-type companies are. So companies or investors are de-risking by investing later stage, and they're also focusing on particular sectors, industries, and geographic regions. So if you don't fall within one of those favored regions or sectors, you will especially have difficulty accessing early-stage equity investment. With respect to lending, we've seen, again, with lending to larger businesses has recovered to close to pre-crisis levels, but that's not the case with smaller businesses. So we've seen continued declines in small business lending. A lot of companies continue to rely on really poor forms of finance, including credit cards and high-interest credit card debt. So, and then just to complete this picture, if you look at the IPO markets over the last couple of decades, we've seen continual declines in small company IPOs. So what Intel was able to do in the 1970s in order to access public markets probably would not happen today. Companies have to wait until they're larger, more mature, before they would even dare test the public IPO market. So it's within these spaces that I'm focused on here. These are some gaps in early-stage equity investment, lending, and also kind of that small company IPO marketplace where we've seen some problems arise in that pipeline.
When you say let me jump in there for a second.
Go right ahead.
Yeah, when you say your focus, what are you doing to change the landscape on this? Give us some insights into some of the practical, the mechanical parts of what you do within the statement you just made.
Sure. So, what we've been doing is, and Vince mentioned this earlier, is the Milken Institute focuses a lot on financial innovation and where can we look to the market and look at new developments to help solve certain challenges. So I'm especially interested in the use of technology and the Internet to help at least solve some of these problems or help to solve some of these problems that we've seen. And a lot of that has been predicated on the Jobs Act legislation. So the Jobs Act is a fairly comprehensive piece of legislation. I mean, most people focus exclusively on the crowd investment parts of it, Title III, but there's a lot more to the Jobs Act. And I mean, we can, throughout the discussion here, walk through some of those different pieces of the Jobs Act. But what we've done here at the Center for Financial Markets is explore each of the different titles and really look at how sound policy can help markets to close or plug some of these gaps in the pipeline. So, we can certainly start to walk through if that makes sense to you guys.
Yeah, I would love to hear. I mean, we've got 2 segments that we could fill up with this conversation, and somebody is going to come away with a takeaway message that's going to help them today. And I want to see if I can facilitate that.
Absolutely. So, when you look, so going back to the point about the Internet, it's like the Internet has impacted and to a certain extent disrupted many industries, and it's been more evolutionary, though, with finance. So what the Jobs Act, I think, is building off of is the movement we saw begin in the 90s when you had online discount brokerage firms, Charles Schwab and Ameritrade, that were able to utilize the Internet to increase the amount of information they were able to disseminate through the Internet. It decreased the costs of participating in certain markets, and it increased opportunity for investors. So if you think about that paradigm, and then we shift to the Jobs Act and what it is enabling, I think you can see much of this as being an evolutionary step from the way the Internet began to impact finance in the 90s. So Title II of the Jobs Act is the provision that lifts this decades-old ban on mass marketing of private offerings. So, historically, a Regulation D, a Reg D private offering that is not registered with the SEC could only be sold to a very closed network of accredited individuals. Those are high net worth or high income individuals. And you were not permitted to advertise that kind of an offering because it would shift it from looking like a private offering to something that felt more public, and that would require a filing with the SEC. So Title II of the Jobs Act lifts this ban on the mass marketing piece. It's still true that only accredited investors can participate in the market. But by lifting that ban, it really opened up new forms of communication. So what this means is that issuers or companies are able to actually broadcast out to the general public that they are seeking to raise funds, though I will qualify that by saying the ultimate buyer still must be an accredited investor. So that's the Title II part of the Jobs Act. Title III, where we talk about crowdfunding.
Let's do this, Daniel. We're going to come up against a hard break. Let's take a break and talk about Title III on the other segment, okay?
Sure.
All right, we'll be right back with Daniel Gorfine. He is a financial markets policy and legal counsel for the Milken Institute, and Vincent Molinari, founder of Great Global Impact, our impact investing and crowdfunding correspondent. And special thanks to Monk Media and 1-800-Public Relations for all their PR, publicrelations.com for all their PR and media support. We'll be right back.